This is a production of the Michael Parsons Trading Institute. All rights are reserved. No duplication or distribution is permitted without written authorization. Michael Parsons Trading Institute presents Balanced Dynamics, the video series. Disclaimer required by the CFTC: the trading of any financial instrument is risky and can cause substantial loss, including the trading of futures, stocks, mutual funds, or options. The use of stops may not limit losses to the intended amounts. Only risk capital should be used to trade futures, stocks, or options on futures or stocks, or mutual funds, or any other financial instruments, whether in conjunction with this product or otherwise. All investments and trades carry risk, and you ultimately make all trading decisions, and you are solely and individually responsible for the decisions and the results of those decisions. Past performance is not indicative of the future results. Not all trades were executed in the actual markets, and the impact of the results can be over or understated. The results and sources are believed to be reliable, but no assurance is made for accuracy or completeness, and is subject to change without notice. You must be aware of the risk and be willing to accept them in order to invest in any financial instrument, regardless of the market. Don't trade with money you can't afford to lose. This is neither a solicitation nor an offer to buy, sell any financial instrument. No representation is being made that any account will or is likely to achieve profits or losses similar to those discussed in any of our trading materials or websites. In other words, if you risk it, you can lose it. Balanced Dynamics Video Number 2, Basic Concepts, Part B. In this next video, we'll learn to identify balance point centers because they are the key for determining exactly where the balance target is at. The first thing we'll learn is what is a price split. Secondly, we'll learn what is a bar split. Third, we'll learn what is a doji bar. Fourth, we'll learn to determine the balance point's natural path. Fifth, we will learn to determine the end of the prevailing trend. And sixth, we will learn to determine the price target of future trends. The first thing we want to identify is what is a price split. Unlike the bar split, the price split is in fact a pattern that develops in the market, and it shows up in a variety of ways. We only have one example showing here because we will be looking at some actual examples very shortly within a market chart. For now, just take a look at this and examine what it is that makes this pattern a price split. You see the market rising and then fall, and then gaps higher and falls again. The highs of these bars are really in line with the lows of these, even if they are separated slightly. In fact, you can take a line and draw it directly through it, splitting the whole activity. This is why it's referred to as a price split. What identifies it is not whether or not it has a gap, because many do not have gaps. You may have a bar that runs right through the center, but the activity where the highs and lows establish that there's a separation or division. And that division is what's key or important here. In many cases, it may be horizontal, but the majority by far will be diagonal, either this way or the other way. In either case, it is the activity of the highs and lows of the bars in general that establish the split. A bar split is a little bit different than a price split. Whereas a price split involves a pattern, a bar split involves the separation of two bars or two candlesticks. The reference is rather subtle, but still a separation between the two levels is indicated. An example can be seen with this first pattern. You see the market move up and then move down and back up again. And it continues, but at one point, there's a point where the bar closes at one level, the next bar opens up at the same level, or slightly off of that, and because of the normal activity of the market, it's clear that there's a distinction here, that there's, although subtle, there is a separation or split. This is referred to as a bar split. The second pattern is a little bit more clearer, because in this case we have the movement up and down, and a separation is actually a small gap. Again, this is a form of bar split. The third example is that of the doji bar. The doji bar is a small bar where you have a similar open and close. And in this case, we have a pattern move up and down, and then is separated by one doji bar that separates the two bars that it's between, the prior bar and the latter bar. And the market continues on as normal. This separation with this single doji bar is, again, a bar split. Well, let's look at some actual examples of price splits and bar splits and what they would look like. Now, the first thing I want to point out as we look at this market, which is the British pound against the US dollar, is the fact that I'm going to be showing you some of the easy ones here. I'm not going to go to any complex ones or subtle ones that are hard to identify, thereby giving you an opportunity to see them easily. But there are many more in this particular market that I could show you that I will not be bothering to point out at the moment. First off, let's look at a bar split. Now here's an example of a bar split right here. If you look at it, you'll see the market move down and close at a certain price level. And what did the next bar do? Well, it opened up at the same price level. Even though you do have a spike in either direction, it didn't open and close at those levels. You can see clearly where it opened and closed, and the market declined directly off of that. So obviously there's a split. Now if you look at that split horizontally, you will see that some lows are supported over here, and it does create some other points where the market reacts, like over here. Still, it doesn't stand out in this narrow neck of the woods, so to speak, as a split until you look at it from a price split standpoint, which is a diagonal perspective. If you take these lows and establish it through the split, what do you see? Well, it identifies this actual high here and a clear split between the price activity that you find right here. Now, what does this split tell us? Either the bar split or the price split? Well, it tells us the market, which had been moving downward, will continue to move lower. And you can see the end result over here. Clearly, it was an important piece of information for trading. This is very common. Another bar split can be seen over here, where we see a similar situation. We have a high close, and the following bar opens up at the same price level. Again, there's a spike in either direction beyond that, but where the open and close or close to that proximity is where a split occurs. And there's a division there that we can even mark horizontally. Now there's some reaction points that you see back here and even right here. So clearly it splits the market. However, the real standout at this particular time, when this formed, was the diagonal perspective, and you can see why. If we draw a line off of the highs through this, well, what do we find that happens? Well, we find a reaction right where it's hit, and the market does what the splits actually tell us. In both the bar split and the price split, it tells us the market will be moving higher. So clearly, a very important piece of information. And this is typical. Now, not every price split is going to also have a bar split. An example where you would not see a bar split in line with the price split, and remember that the majority of price splits will have bar splits. There are exceptions, as you see right here. If you take these two highs and run them through to this low, you can see where they identify the lows here and create a split in this pattern. But if you look at the bar, well, it doesn't really have a split at it at all. It's just a long bar, and it's really splitting it down the center. If you looked at a lower time frame, well, perhaps you would see a split right at the location that the line goes through. But there's no question that the pattern itself establishes a split, even though you don't have a clear identifiable bar split. And what does this tell us? Well, the pattern itself tells us the market's going to move higher, as you see that it actually did. A more common scenario is where you have a bar split, but no clearly identifiable price split pattern. So it's important to be able to identify the bar split when it occurs, because otherwise you could miss out on a trade. Well, the fact is that many times a pattern will form eventually. Sometimes there's not enough data to work with until the trade's already gone and passed. Therefore, if you can identify the bar split itself, you're in a much better position to take advantage of the trade. A case in point can be seen right here, where we have a split, almost to the point of a gap. Clearly, all the activity here prior to the split is above this particular line. When it opens up at this level, clearly creating a split or a gap, and while it may have spiked higher, a clear action of the market was to decline, as you can see here. But if you look at it from a pattern basis, well, it's hard to put your finger on one until it actually finishes out its move. If you look at it, there is a horizontal view that you can take, and you can see points where there's a high here and a high here reacting to the market, and a low here even. You can also look at it from a diagonal standpoint. Eventually, we do get a price split that runs this course, and you can see the high reacting to it. And in fact, you can even go back further and see the split occurring through here, where a number of highs and lows in fact impact the market, and again this high plays a role. But that may not necessarily be easily identifiable. Later on, we can even see where the market makes a further move. If we expand this a little further, we can see where, coming through here, we have a bar split, and eventually the market reaches just where it is at the moment, at that high. And so the bar split does play a role in creating a price pattern split that we can identify and use later. But at the moment of this particular swing, well, getting this particular movement or decline as we see in the market was dependent upon identifying the actual bar split. And so identifying that plays a key role in being able to trade it and take advantage of the move. So therefore, look for these splits, and while this is subtle, because you do have the market spiking the crossover, if you look at it closely, there's no question there is a definite difference between these two levels of activity, the upper level and lower level. Looking at some other examples of bar splits, we can find numerous through the market. For example, here we see the traditional close at the same level as the open, and the bar continues to move or trend. Here we have a gap, even though it does spike over the gap. The market closes one level, opens up substantially different, and creates this hole in the market that, while may be filled, still creates a point of support for the market to move higher. Here's a doji bar example. We don't see it too often, but it does show up enough. And as we pointed out in the very beginning when we gave the examples, situation where the market closes one level, the doji bar opens and closes the same level, and the following bar opens up at the same level and then proceeds to continue with the trend. Here we have a gap in the market. We have a couple of splits here. We have two doji bars here, which creates a split, and following that the market continues to climb higher and higher. And so there's numerous examples to choose from, and we can continue this over and over and over because there are many bar splits that will occur in the market, all indicative of some type of important information of what the market's going to do. And so it's important to be able to recognize these, even though they are subtle. The more you look at them, the more you find them, the easier they will be to identify and to actually use. At this point, we need to focus in on a specific type of bar referred to as a doji bar. This bar has unique characteristics in that the open and close are very similar, much like a plus sign. And it's important to us because it acts as a short-term pivot and is frequently seen around balance points. While not all dojis lead to a balance point, their use in trading is significant in practically everywhere that they show up. We'll show you how in just a minute. The first thing that I want you to do is take note of some actual examples of doji bars and the impact that they have on the market. We want to look at the characteristics they exhibit and also what happens following their occurrence. A couple of examples can be seen here. Now, under candlesticks, a real doji bar is a narrow bar with an open close at the same level, and it can be a rather strict interpretation. For our use, we interpret a doji bar with a similar open and close. It doesn't even have to be exact. It can be slightly off, but it will be a very narrow range between the open and close. Further, we don't have the same requirement between the high and low being equally set on both sides. One can be deeper than the other. For example, this bar here, well, the low obviously extends much further than the high. Still, it has a similar open and close, creating a pivot, and that's what we're looking for. And we see the impact that it has on the market, that from this, the market declines. Another example can be seen here. With this doji bar, the market declines until it reaches that price level, has a hard time moving any further. The following three bars, well, it acts as resistance, and it can't overcome that price level that's set by its open and close. And following that, it declines. Here we see three bars that fit the characteristics of a doji bar. And here they act as, again, a point of resistance, and the market declines. Now there are a number of other examples here that we'll talk about in just a moment. But the key here is that this bar acts as a pivot, and its characteristics exhibit a narrow open and close range. It can be a long bar, as long as its open and close is the same level. It can be a narrow bar, again, as long as the open and close at the same level. The open and close can be slightly off, but it must be a very narrow range if this is the case, and preferably at the same level. This is the characteristic of a doji bar that we use and interpret in our use here and analyze and market for balanced targeting. In regard to the activity that we expect from that, it acts as a pivot. So it should act in the majority of cases a situation where it's like support and resistance. If the market moves higher, well, then odds are it will continue higher, at least for a couple of bars. If it goes lower, well, then we expect it to move lower, at least for a couple of bars. Now, it is a short-term indicator, not a major one. But when it is found in line with a balance point, it is a key point and often the actual center of that balance point. And we'll talk about that in just a moment. Now let's take a moment and look at some of the doji bars that we've identified in this market and see their significance in regard to our balanced targeting. For example, we have a number of up here, we have one right here, we have one right here, we have one right here. And I should point out that this is part of a balance point, so this is going to be more significant. And there are others, of course, but let's just focus on these and see what we come up with. For the sake of argument, we're going to slide this over so we get a better view of the chart, and it's low. And we're going to take the point for the first doji bar and use it to calculate through the second one. And what do we end up with? Well, we end up with basically our next doji bar, which was a pivotal location. Okay, fine, that's good. What's the next thing that we get out of this? Well, let's take, again, the high and pivot it through the next doji bar. And what we end up with is basically this low area where you see a reaction in the market, and the market pulls up. Now that's just a pullback, and so let's take a look at the next doji bar, which is right here. And we're going to use the same basic location, if I can get our mouse on it, and pull it down here, and we're going to go across. And note, as we mentioned, this is a more important balance point, doji bar, and we can see the end target is the low of the trend. Very powerful indeed. The fact is that you could go down the line and use other doji bars here, and they would have significant and short term in one way or another. And we'll talk about how to use that later on. But here you can see an example of the significance that doji bars have. The next thing on our agenda is to be able to understand how to determine the natural path of a balance point. You see, although each pattern will be different and balance points will exist both in small swings and large swings, typically there is a natural path that develops in the majority of patterns that enable you to locate exactly where that balance point needs to be located, and thereby use it to determine your price targets. For example, let's take a look at a swing that exists right here. Now, there's a pattern here where we have a low that actually targets a high here. The pattern, of course, will involve a balance point that's, well, centrally located in this area, which wouldn't be too difficult to determine simply on a mathematical basis or even a visual basis. But how would we know exactly where that central location is long before this high ever comes in place? Well, let's take a look at a few factors when we draw a target line right through this pattern. If you look closely, you will find that there is a bar split that exists right here. But that's not all that we have to work with. You see, there is a low here as well as a high here. And these two provide a target basis. They are, as what we refer to, a self-targeting pattern, high and low. This balances or directs the line exactly where it would be located, thereby making it much easier to determine that where the market hits this line up here is where the end of the swing will occur. Let's take this a step further. Here we've determined a target high. Can we use that high to determine how far this market, after swinging up and declining, will finally turn around and proceed higher, giving us a buy opportunity? The answer is yes. If we look at this natural swing here, we also find that there's a break right through here, a natural path. Now this one's important because actually we have two potential paths here, and it's a good idea of what some of the things you may run into. For example, the initial choice would be right through where this bar break actually occurs. And what you see is, well, while you might slightly cross through the path of one bar or two, there's actually a gap that exists right here, and a series of lows. So the target is quite a good target line, giving us a low. Now it does creep a little lower than this, but still the decline, well, this is where the market turns around, a great buy opportunity. Still, we have another potential target line sitting right in here, and that exists right here. Now in this case, we are crossing through the path of a bar right here. But one key factor here is that you have a series of highs and lows that border it as well, thereby providing a natural path. And you can see the end result right at the exact low that these bars actually set. Great buy opportunity. Now, in both of these cases, there's obviously no reason that anyone would complain about whatever choice they made or wherever they bought it at, because it made a very nice climb afterwards. Still, the two paths indicate that this is a range that you would normally find it. Now, it's not common for you to have two target lines, but it does occasionally occur. In fact, you sometimes can have three. The majority of cases, by far, will be a singular target line. The key, though, is simply determining the correct path. And so you have to look at the flow of the market. How do you determine the flow of the market? Well, let's take a few examples and look at these here and what it is that makes a difference. There are four things that we will be identifying and using to help us assist in determining the actual natural path of a balance point. So what is the key to determining the natural path? It all boils down to this simple single phrase: the path of least resistance. Remember this phrase, the path of least resistance. You can locate the path of least resistance using one of these 6 factors in determining where that central point is. And oftentimes they will include more than just one of these. They include 1. A series of subtle highs, lows, opens, and closes. 2. A self-targeting pattern. 3. Gaps. 4. Doji bars. 5. Bar splits. And finally 6. Contrary bars. Going back to our chart, let's look at a few examples of how we would utilize these factors to determine the natural path of a balance point. Some are quite easy. For example, here we have a gap, and you can see it's centered between the low and high of the swing. And that in turn can be used to target by taking a prior high and running it through the gap, a low that will come in later on as we do in this swing here. You can see how well it worked. Here, for example, we have a swing where the market comes down. How far will it move up? Well, the first target can actually be determined by looking for a balance point. And what do we see? If you look closely, there's a doji bar right here. And it is the only point where you would divide the swing itself. And so therefore you can actually take a low anywhere along the line and target it through it. And you would end up with a natural path and would give you the target that we have up here. And so you can see, again, how effective that worked. And this principle can be applied in numerous locations. And we're going to look at a couple of examples in some other markets as well. But you can see how simple this works. Now, obviously, there are a number of places we can look at here and that we're not disclosing or going into at the moment because it's a little bit more complex. We're just looking at simple examples for the moment so you get an idea how it works. We'll come back later with more complex examples. And as time progresses, you'll get a better feel for what to look for and what to find. The key is using one of the factors that we provide or more to help you isolate the natural path. Another good example is that of the 30-year T-bond. We find a lot of simple examples where the market itself is very clear on the balance points. An example can be seen here. Where we have a gap. But we also have a low that's targeting a high. So we have a self-targeting pattern as well. So there are two factors that come into play to give you or determine exactly where the natural path of the balance point will be. And what do we end up with that? Well, when we go through that target, or the natural path, we end up with this target as we see right here, where the market tops out. A very excellent example. Now, whether you're dealing with a longer-term move, as we see from this low to this high, or a smaller swing, perhaps from this low to this high, every single swing will have a balance point. Now, some will be so small or so subtle that you'd have to go to a lower time frame to actually make out. But in most swings, if you see multiple swings or any length of time on the market or swing, such as you do from this high to this low, or even from this low to this high, then typically you will not have a problem finding multiple balance points to work with. Even in this swing here, where the market moves up and then moves back down, is there a way to determine how far this market's going to move up before reacting to the market or taking a breather, and perhaps a good point to take profits? Well, let's take a look at this. In this case, we actually have a couple of bars right here where the lows are guided upward and settle into this long contrary bar, creating a point that's almost like a triangle for a natural path. And this is what our focus will be. Therefore, we can take a prior low and run it directly through there at that point and find an actual high. And you can see where the market reacted here. Now, what we haven't discussed as of yet, and we will in more degree later on, is the fact that multiple points lead to multiple points. We have actually two lows here. So technically, there's a second one that should extend further, and we do see that up here. So we have a basis for determining, not because there's a gap or because of the self-targeting pattern, but because of subtle lows here or a contrary bar that allows us to find or locate the actual point where the natural path will be. Another example can actually be seen right up here. Again, we see a contrary bar right here, but we also see multiple lows directing the market upward. And it creates, again, another pinch point where the market pattern has a natural path. And we can therefore take a prior low and run it directly through that. And we end up with a target, as we see up here. And you can see how effective that was. Even the pattern in the contrary direction, you can see that there's a bar split that exists right here, plus multiple highs and lows. And you can simply run the target line directly through to see exactly where this market will come back down to and where you would want to buy into the market again, as we see right here. Another good example would be found in the monthly chart of orange juice, and I like this for a couple of reasons. First off, let's look at this balance point here. Here we have a doji bar. Now this is one of the factors that we mention that can be used to find the natural path of a balance point. But in addition to that, we have a series of highs and lows that border it, creating a self-targeting pattern as well. And if you take a line, for example, a prior high, and run through this pattern where this doji bar is, and we get set up right, what we target is this series of lows you see right here. What's interesting is the fact that even though we do exceed it with some spikes, the majority of activity, well, it's actually quite a ways away from the line. It's definitely bordering it. In fact, if you look at it from the basis of a line chart, you can see how separate it actually is, way down here as opposed to way up here. So clearly, it is creating a guideline or guide direction for the market to go through, a high and low creating a support and resistance factor. Going back to the chart, if we wanted to look at from the other direction, from the low to the high, we can actually take this right to our natural path or doji bar, and we end up with what kind of target? Right at the very top, as we see right here. Now, the other reason that I wanted to look at orange juice is because of another factor. Now, actually, right here, an inverse occurs, and we'll talk about inverses later, but basically, to sum it up, so you know, technically the market should have been targeted right to this level here, and because it's inverse, it doubled that direction and went up a little higher. And we'll talk about that and why later. But what we should see is a target right to this from prior activity. Now, where do we find that? Naturally, we would look at this swing and seeing if this low targeted it up to this area. But what point would we use? There's a balance point that exists here. It's not too difficult to see. But if you follow some of the things that we talked about earlier, you might be inclined to place your target line right here. Why? Well, you've got a series of lows here, which is something we talked about, contrary pattern, and you even have this spike that extends upward and creates support for the line. So it's a nice pattern, to say the least. The problem is, well, it doesn't exactly target where we went to. It targets these lows, these bars that come down to create a lower support, and that's fine. It does have value there. But it doesn't give us an exit point to lock in profits. The fact is we exceeded it quite a bit. What happened here? Well, the reason is because this is technically not the natural path. Now, why do we say that? Well, I want you to take note of something, and this is where the subtle highs and lows come into play. At this point, through this line, we do cross a bar. Yet if you look a little higher, right here, you will see that we have this low and this low that are pretty equal. And there's a division between this bar and this bar where you can go right between them and have support right on this high. So if I draw a line from this prior low right through here, you can see that, well, I crossed right through, find support on this high, find resistance from these lows, and all through it, I don't pass through any, not one single solitary bar. I have a clear shot all the way to the target, and you can see where the target is at. Beautifully done. Remember the key that we mentioned earlier, the path of least resistance. Now this is beautiful, no questions asked. If this was all we had, this is the definite choice we would go with. But in this case, we do have another path that has even less resistance. That just a little higher, as we see right here. And this is one of the keys. The subtle highs and lows allow it to pass through with even less resistance, thereby providing a more accurate point for a natural path. So this is an important lesson to learn and take notice of. You'll see how much this applies as we go further down and look at more complex examples. This is a key to enable you to find and determine the natural path even in the most complex of patterns. Look for the path of least resistance. And as we proceed, you'll see many examples of us doing just that. Now that we've covered some basic aspects of what we're looking for to establish a balance point, how would we turn around and use that to target a price level? Well, there are two different directions that we're going to approach this. One with the current trend and the other through a cross-targeting method. Now, throughout a market, there will be balance points everywhere, but some will be much more significant than others. Obviously, if I'm looking at a swing like this, I'm more interested in where this balance point is rather than what every little swing has a balance point, contains a balance point. Those little balance points are not much consequence to me. I'm looking for the major moves or major swings. In this live market that we're looking at, the S&P E-mini, it's not too hard to see that we have a cross pattern here and a cross pattern here. And the balance point is contained right within a bar split here. Now, why do I say that? Because you can actually take this low and target this high right through it, meaning that it's not too difficult to locate exactly where this is going to be at. It's pretty well giving you the answer right in the pattern. So we have both a bar split and a self-targeting pattern. Once we establish the pattern, we need, of course, to determine where the natural flow will be, where the natural path exists. And that, of course, is in this case where that bar split exists. In a current trend, if the market is declining, I'm looking for how far the market will move down to, a point where I will take profits and exit the market. The way that I would do that is using a simple tool that's referred to as a Fibonacci support and resistance. Now, you may have this tool in your chart system. If you don't, you can simply do this mathematically. But let's take a look at this for a moment. It basically is a Fibonacci support and resistance. And what I've done here is that I've removed the Fibonacci ratios. Instead, I have 0, I have 50%, and down here below, I have 100%, as you can see right here. This enables me to spread this tool from atop, allow me to place the 50% level at wherever my balance point is at and bring it down. And you can see where I end up. I end up with a target of 14.20 and a quarter. The market did slip a little lower, and that has to do with the market bias. As you can actually see in live trading at the moment, the market is very strongly moving down. And we'll talk about the actual market bias and how it impacts the targets later on. But for now, it's obvious that this is a point that I'd want to take profits. And no matter where I may have entered in up here or even down here, well, it would prove a rather profitable trade, as you can see here. The key here is locating the actual target. And that's simply a matter of doubling whatever your balance point is from the point that you actually started, a high or low. This enables us to target it very simple mathematically. Now, if you don't have this tool, then you can simply do it mathematically. How would you do that? Well, you take the 14.30 and 3/4, and you take the 14 and a quarter, 14.25 and a half, and you subtract it from your 14.30 and 3/4. That difference you will subtract then from your 14.25 and a half, giving you your 14.20 and a quarter. And that would be your price level, and then you simply mark it in however you desire, whether actually in your trading system, to the actual exit or limit order to get you out of that specific price. Aside from a cross-targeting current trend method, we also use the balance point for determining a cross trend. And what we mean by that is that we're taking prior lows and highs and targeting it. Now, unless we have an inverse, which is something we will discuss later, typically a low will target a high. If you have the opposite, a high, then it will target a low. Typically, it will be the opposite of whatever we're looking for, or what we started with, meaning that we would take this low, target it right through the balance point, or what the natural path is, and that would give us our target as we see here. A little shy, but that again has to do with market bias, which we'll discuss later. As you can see, this, for anyone who bought into the market when it started to rise, this would be an excellent point to get out, allowing a little conservative exit or a little lower to allow for any problem in reaching your order or target level. And we'll discuss specifics in how to trade this later on, but this is the basic concept. Mathematically, you can do the same thing as we did before. Simply take the low, center it at the balance point, and you're going to end up with your actual price level target, as you see here. You can go 1426 minus 1425 and a half. Well, it gives you the difference that when you subtract from 1425 and a half will give you 1425. Mathematically, there is an advantage to doing this even on a cross-trading or cross-trend targeting, but usually a line is sufficient to mark the actual trade. In any event, it's as simple as this, and you can use this repeatedly in numerous locations. For example, we're in a current downtrend. How far will it go? Well, we're already meeting a price target, as we can see here, and it's responding off of this, right off the price target. And this is what you can repeat over and over again. It's a simple matter of, first off, locating the balance point, as we see right here, locating the natural point of the path or a center point, which we find right here with this bar split, and then using this from any prior high or low to target, whether it be the current trend, to target the end of the trend, or a cross-targeting method from a prior high or low to target the next high or low. Again, unless it's in the case of an inverse, a low would target a high would target a low. Balance Dynamics video number 2, Basic Concepts, Part B. All methods and techniques are those developed by Michael J. Parsons. The videos are narrated by Michael J. Parsons. Director of Marketing, Osman Yuza. Technical Support, Melissa R. Parsons. Accounting, Ray V. Parsons. And Translation, Heather L. Parsons. This is a production of the Michael Parsons Trading Institute. All rights are reserved. No duplication or distribution is permitted without written authorization.